Investing in real estate can feel complicated, filled with big numbers and even bigger risks. Many new investors look at single-family homes, apartment buildings, but these require large capital. I discovered a different path: mobile homes, impressive returns with a smaller initial investment. The key isn't a hidden secret or a complex financial model, it's a simple, powerful rule of thumb. This rule lets you quickly sort deals, focus on ones that can make you money from day one. It removes emotion, forces you to look at cold, hard numbers. The rule is called the 2% rule. It's a straightforward mathematical filter, compares gross monthly rent to purchase price. Core idea: gross monthly rent, 2% of purchase price. Example: buy a mobile home for $20,000. The 2% rule is one of the simplest yet most effective tools in a real estate investor's toolkit. It's a quick screening test to gauge income potential. The rule: gross monthly rent should be equal to or greater than 2% of the purchase price. Formula: monthly rent, purchase price. 0.02. If a deal meets this, it's worth a closer look. If not, it's unlikely to produce strong cash flow, so move on without wasting time. Especially useful when cash flow, not appreciation, is the goal. Example time. Imagine a mobile home for sale priced at $15,000. Apply the 2% rule. Multiply 15,000 by 0.02. 15,000 times 0.02 equals $300. So the unit needs at least $300 per month to pass. If market rent is $350, it passes. If market rent is only $250, it fails and likely won't cover expenses. Remember, it's a starting point, not a final verdict, a filter, not a full analysis. Passing doesn't guarantee a great deal. When it comes to real estate investing strategies, it's rare to find a perfect pairing. But mobile homes and the 2% rule, they are a match made in financial heaven. And the reason comes down to a powerful combination of simple economics, market dynamics, and the very nature of the asset itself. It's a formula that allows investors, even those with limited capital, to unlock cash flow potential that is often out of reach in traditional real estate. The primary factor, the one that underpins this entire strategy, is the remarkably low acquisition cost of mobile homes compared to traditional site-built houses. The difference isn't just small, it's a complete paradigm shift in entry-level cost. It is not uncommon to find used, older mobile homes that need some cosmetic work for sale for $10,000, $20,000, or even a solid habitable unit for $30,000. In contrast, finding a structurally sound single-family house for under $100,000 is extremely difficult in most markets today. In many areas, even entry-level condos start at double that price. This massive price gap is the foundational advantage. Because the purchase price is so much lower, the monthly rent required to meet the 2% threshold is much more attainable and realistic within the local rental market. Let's break down the math. For a $20,000 mobile home, the 2% rule says you should aim for a gross monthly rent of just $400. In many communities, this is a very competitive and achievable rent for a clean, safe place to live. Now let's apply that same rule to a modest $200,000 house. The target rent would be a staggering $4,000 per month, a figure that is completely unrealistic in most rental markets for that type of property. The local wages and rental demand simply won't support it. This low entry cost creates a unique opportunity for exceptionally high cash-on-cash returns, especially when you can avoid financing. At its core, the 2% rule is fundamentally a measure of gross rental yield. It's a quick screening tool to gauge the income potential of a property relative to its cost. Because mobile homes are personal property and have a low price point, they can often be purchased for cash, avoiding mortgage payments, interest, and loan origination fees entirely. This means the path to positive cash flow is much more direct. Every dollar of rent that comes in, after park fees and expenses, goes straight to your bottom line. When you can buy an income-producing asset for a relatively small amount of capital, the return on that capital can be substantial, even if the dollar amount seems small at first. The math just works out more favorably. Your initial investment is smaller, your break-even point is reached faster, and your percentage-based returns are magnified. Think of it this way. There's a huge spread between the affordable housing demand that drives rental rates upward and the incredibly low purchase price of the physical asset itself. That gap is where the magic happens for mobile home investors. It's an arbitrage opportunity that's hard to find elsewhere. This dynamic is far less common with more expensive traditional real estate, where high purchase prices often move in lockstep with high rents, squeezing the potential profit margin for landlords. Another critical reason this asset class works so well with the 2% rule is the unwavering nature of the rental market for affordable housing. Across the country, in good economic times and bad, there is a consistent and high demand for clean, safe, and affordable places to live. This isn't a luxury market, it's a necessity market. Mobile home parks often cater to this exact demographic, providing a crucial housing solution for retirees, young families, and working-class individuals. This steady demand helps to keep rental rates stable and vacancies low, reducing two of the biggest risks for any landlord and making your cash flow projections more reliable. To truly understand the power and the pitfalls of mobile home investing, theory isn't enough. We need to get our hands dirty with real numbers. So, let's bring this to life with two clear side-by-side examples. Think of this as a tale of two investments. One story will illustrate the path to success, while the other will serve as a cautionary tale, highlighting the red flags you must learn to spot. We will look at a good deal that meets the 2% rule, a property that signals strong potential from the very first glance. And we'll contrast that with a bad deal that falls short, a scenario that looks tempting on the surface but hides financial drains beneath. First, the good deal. Let's call this the cash flow champion. Imagine you're driving through a well-managed park and spot a for sale by owner sign. You find an older but well-maintained mobile home. The seller is asking $22,000, but after a friendly negotiation, you agree on a cash purchase price of $20,000. Before making that offer, you did your homework. After researching the local market and the park it is in, you spoke with the park manager about the community rules and confirmed that other similar homes in the park are renting successfully. Based on these comparable rentals, or comps, you determine that you can confidently rent it for $500 per month. Now, let's run the numbers. This is where the deal truly reveals itself. First, our quick filter. We apply the 2% rule. Taking the monthly rent of $500 and dividing it by the purchase price of $20,000. That equals 0.025, or 2.5%. This deal comfortably exceeds our 2% benchmark, so it is worth investigating further. It passes the first test and shows strong income potential relative to its cost. This is a green light to proceed to the next stage of analysis. Now that it passed the initial filter, we dig into the detailed expenses. This is the most critical step. Never skip the details. Let's say the monthly lot rent for the space in the park is $200. This is your single largest operating expense. A landlord insurance policy for a home of this value costs you $30 per month. We will set aside 5% of the rent for a maintenance reserve, which is $25. This fund covers minor repairs like a leaky faucet or a broken screen, and we'll budget another 5% for a vacancy reserve, another $25. This prepares you for the month or two the home might sit empty between tenants. Your total monthly expenses add up to $200 plus $30 plus $25 plus $25, which equals a total of $280. To find your monthly cash flow, the money that actually goes into your bank account, you subtract your total expenses from your rental income. $500 minus $280 equals $220. This means the property is projected to put $220 in your pocket every month after all known expenses are paid. Annually, that's a profit of $2,640 per year. But let's go deeper. What's our cash-on-cash return? We divide our annual cash flow by our total cash invested. $2,640 divided by $20,000 gives us a return of 13.2%. That's a fantastic return on your money. And the cap rate? That's our net operating income divided by the price. Our NOI is the annual rent minus all operating expenses, which comes to $3,240. Divide that by 20,000, and you get a cap rate of 16.2%, an incredibly strong indicator of profitability. This is a great result, showing how a deal that passes the 2% rule can generate strong positive cash flow and excellent returns. This is the kind of deal worth pursuing. Next, let's look at a bad deal, which we'll call the hidden money pit. You find another mobile home that looks appealing on the surface. It's a bit newer, in a different park that seems decent enough. The asking price is $30,000 and the seller is firm. Section 5. The hidden costs that can sink your profits. The 2% rule is an excellent starting point, but its simplicity is also its weakness. It only considers the gross rent and the purchase price. A deal can look fantastic on the initial screen, but if you fail to account for real-world expenses, your profits can vanish into thin air. The single largest expense for most mobile home investors is the lot rent. You often own the home, but not the land, so you must pay a monthly fee to the park owner. This fee can range from a couple $100s to over $1,000 in high-cost areas. It's a non-negotiable recurring cost that reduces your cash flow. Verify lot rent first when analyzing a deal. Beyond lot rent, repairs and maintenance are silent killers of cash flow. Roofs can leak, plumbing can fail, furnaces can break down in winter. These are not if events, they are when events. A smart investor budgets for them. Set aside a percentage of monthly rent, typically 5 to 15%, depending on the home's age and condition, into a dedicated reserve fund. When a $1,500 repair bill arrives, you have the cash on hand to cover it without derailing the investment. Another underestimated cost is vacancy. Section 6. Finding good mobile home deals requires a proactive approach. They are not always listed on major real estate sites. Zillow, Realtor.com. Your search needs to be more grassroots and direct. Connect with mobile home park managers. Drive through local parks. Note parks that are clean and well managed. Call the numbers on for rent signs. Call the numbers on park manager signs. Introduce yourself as an investor. Managers often know when residents plan to sell. Sometimes parks sell park-owned homes. Explore online marketplaces and classifieds. Facebook Marketplace, Craigslist. Mobile home-specific listing sites direct sellers often priced to sell quickly. Use keywords like mobile home for sale, manufactured home, must sell. Look for sale. Buy owner signs in front of homes. Check community bulletin boards inside parks. This is old school, boots on the ground work. Once you have a potential deal, vetting begins. After confirming the 2% rule, do a thorough inspection. Watch for major red flags. Check the roof. Inspect ceilings for water damage. Walk and feel floors for soft spots. Inspect skirting. Section 7. Now it's time to put all the theory into practice. Let's walk through a complete, real-world calculation for a mobile home deal, moving beyond the simple 2% rule to a full, detailed analysis. This is the most critical step in your due diligence, where you transform a potential opportunity into a concrete business plan. Imagine you find a mobile home for an asking price of $25,000. It's a decent-looking single-wide in a well-kept park. You have done your homework. You've researched comparable rental listings online and spoken with the park manager to confirm that a fair market rent for this unit is $600 per month. First, you run the initial 2% rule test as a quick filter. 600 divided by 25,000 equals 0.024, or 2.4%. The deal passes the test, since 2.4% is above our 2% minimum. This green light tells us it's worth investing more time to analyze. So, it is time to dig deeper into the numbers and build a simple monthly budget for the property, often called a pro forma. This is where you move from a rule of thumb to a real business projection. Accuracy here is key. Next, you need to identify and quantify all of your monthly expenses. Don't guess. Verify every number you can. After speaking with the park manager, you confirm the lot rent is $250 per month. You also ask if any increases are planned for the next year. For now, we'll use the current rate. You call an insurance agent and get a quote for a landlord or rental dwelling policy, which comes to $40 per month. Since the home is a bit older, you decide to be conservative and set aside 10% of the rent for a maintenance reserve. That's $60 per month. This isn't a bill you pay monthly, but an amount you save for future repairs, like a plumbing issue or a broken appliance. You also need to account for the risk of the home sitting empty between tenants. We'll use a standard 8% for a vacancy reserve, which is $48 per month. Again, this is money you set aside to cover expenses during turnover. Let us also assume you've checked the county assessor's website and found that annual property taxes are $240, which works out to $20 per month. It's crucial to budget for taxes monthly, so you're not caught off guard by a large annual bill. Your total estimated monthly expenses are the sum of all these costs: lot rent, insurance, maintenance, vacancy, and taxes. This equals $418. This number represents your total monthly obligation to operate this rental. With your income and expenses laid out, you can now calculate your net operating income, or NOI, which is a fancy term for your monthly cash flow before any loan payments. It's the pure profit the property itself generates. This means that, after setting aside money for all foreseeable costs, this property is projected to generate $182 in positive cash flow each month. Annually, that comes to $2,184 in profit per year. Now, let's determine our return on investment. Assuming you paid cash for the home, your total cash invested is the $25,000 purchase price. We calculate the cash-on-cash return by dividing the annual profit by the total cash invested. This equals 8.7%. This is a solid, respectable return, significantly higher than you might get from traditional investments like savings accounts or bonds. But a smart investor doesn't stop here. We need to consider the risks. What if our assumptions are wrong? This is where a sensitivity analysis comes in. Let's stress test the deal. What if the park raises the lot rent by $50? Your monthly cash flow would drop to $132, and your return would fall to 6.3%. Still profitable, but much tighter. What if it takes you longer to find a tenant, and your effective vacancy rate for the year is 15% instead of 8%? That would reduce your cash flow to $134 per month for a 6.4% return. By running these scenarios, you understand your margin of safety and can make a more informed decision, knowing how the deal performs under pressure. Section 8. Every investment carries risk, and mobile home investing is no exception. Being aware of these risks is the first step toward mitigating them. One of the most significant risks is unexpected and costly repairs. An old furnace failing in January or a roof leak causing extensive water damage can instantly wipe out a year's worth of profits. The best way to reduce this risk is twofold. First, conduct a thorough inspection before you buy. Second, and more importantly, you must maintain a dedicated capital expenditures fund, or CapEx fund. This is the money you set aside every month from the rent. This fund acts as your financial shock absorber, ensuring you can handle major repairs without going into debt or financial distress. Another major risk revolves around tenants. A bad tenant can cause thousands of dollars in damages, refuse to pay rent, and force you into a costly and time-consuming eviction process. The key to mitigating this risk is a rigorous tenant screening process. Having a clear written lease agreement that outlines all the rules and consequences is also non-negotiable. The 2% rule is not a magic formula, but it is the best simple tool I have found for quickly identifying mobile home deals with high cash flow potential.